For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. And we are managing your financial future. Welcome back to the podcast. Happy to have everybody here. I'm happy to be here. Professor Plum, are you happy to be here?
I'm happy to be anywhere.
Yeah, we are. Welcome to the show. I'm your podcast host, Johnny Dean, of course, and Professor Rick Plum, who is a certified financial planner professional.
Look at you using that cheat sheet.
Still using this cheat sheet. I just find this, I love this. This is great. And accredited wealth management advisor. That's right. We got them all together here. Yep, you got the designations, and I've got the radio part of this, or the media part of this, and together I think we do a pretty good job.
Because I have absolutely no idea how to get us on the air or record or do anything.
That's true. So today's topic harkens back to, I like to revisit these from time to time. And we've been talking a lot about buckets and all that kind of stuff this particular season and part of last season as well. This isn't so much buckets as it is kind of decisions that people have to make. We've had questions from time to time, Professor Plum, about, now when we talk about pre-tax money, generally we will use the term IRA, right?
Correct.
We say we have IRA money, we have post money, whatever. I mean, personal money. But we've had questions from people say, well, there are other pre-tax. In fact, some people say, hey, I don't really have an IRA. Most of my savings is done through my 401k. I've got a 401k plan at work. My spouse has a 401k plan, perhaps. And that's kind of what we do. We don't do much in the world of IRAs. Not that there's anything wrong with them, but so the question came up a little while back. Which do you believe, Professor Plum, is better? Now, I know what the actual answer is going to be.
It depends.
It depends.
But it doesn't necessarily, because a lot of this has to do with what works best for you. And for most people, especially just starting off, what works best for them is the one that makes it automatic, the one that you don't think about, the one that you don't see, the one that you don't notice. And that's the 401k.
It is. And the 401k is what now? I think the 401k is almost, let's see, it was 1978. It's coming up. It's going to be 50 years old, believe it or not, here in a few years. So it's been around a long time. And
for people that are working right now, it's been around probably their entire working life.
Right.
Now, in the 80s, not everybody had access to a 401k. Pretty much now, it's more universal, especially if you have a company that's more than like 20 or 30 people in it.
Yeah, I didn't even see one until probably the late 80s when it was offered. But many people, if not most, have access to some kind of savings plan. Well, let's start with these. Now, and I also want to get into the Roth versions of each of these. We'll cover these. But first of all, when we're talking pre-tax, strictly pre-tax, 401k versus IRA, tell me, first of all, some of the benefits of the 401k. You just mentioned one of them, which was the automatic nature of it.
I like, given the choice, everything else being equal, the 401k offers certain advantages. One is that it is automatic. It happens. You don't see it. You don't have to take money out of your budget, because your budget presumably is what goes into the checking account, and you don't see it happening. You don't mess it up. You don't stop it. The systematic system, the automatic issues happening before your check is deposited in your bank account makes a lot of sense to me. Also, you can put automatic escalators on it, meaning it can go up every quarter, every 6 months or so. You save more. Also, many 401ks have matching contributions. I like free money. IRAs don't have matching contributions. So given those choices, now the advantage of the IRA is that it has a lot more investment flexibility. You can invest in individual stocks. Most 401ks you can't. You can invest in any myriad of mutual funds or ETFs. The 401ks typically have a set list, menu of mostly mutual fund options, and in many cases, all target dates or very close to all target date options. So you have, I think, a lot of advantage. Oh, and the other advantage is you can put a lot more money into a 401k than you can an IRA.
Well, that's true. Now we're kind of bouncing back and forth, which is fine.
So I like the idea of the higher contribution limit, the matching contribution availability, the systematic system. It's done before you get your check. It all happens that way. Those are all advantages of the 401k. The disadvantage or the advantage of the IRA is investment flexibility.
Yeah, generally you have a lot more. You have almost an unlimited number of.
Right. The one advantage from an IRA for people creating wealth new into this game is you can use some of that money without penalty for the first-time home purchase. That is not available from a 401k. So what are we trying to accomplish here? Is this money we're saving for our house?
Well, okay.
Maybe not. For retirement, I think the 401k works better with the exception of the investment flexibility.
Yeah. But see, with the investment flexibility, I mean, Professor Plum, well, here's the other thing, and we'll get there's so many ways we could go on this. You have some investment flexibility, I think, in the 401k.
Oh, true. Depending on who you have. Some of them are, have hundreds of different mutual fund choices.
Yeah.
401k that we have has hundreds of choices of mutual funds,
now,
but they're all mutual funds.
See, here's part of the problem with that, though. The fact that I have so many choices with an IRA, almost unlimited. I mean,
paralysis
to me,
by analysis.
You're exactly. I mean, there are so many choices. You honestly, have you looked to see just how many, growth and income funds there are or whatever? I mean, it's almost, I don't want to say it's impossible, but it's very hard to decide where to put your money.
Well, I think especially for younger people or for people starting off, how often do people stay with a single employer for more than 10 years?
Yeah, I don't know.
So, I mean, you start at 25, you have a 401k, you start building it up as much as possible. And in 5 or 6, 7, 8 years, you're probably going to leave that employer. And then you have the ability to make a choice. You can either leave assuming it's more than $5,000, you can leave the money at that 401k. Mm-hmm. You can probably roll it over to your new 401k so you can have ease of management all in one spot. Or you can roll it to an IRA if you want that flexibility of investment choice. So because most people don't stay with the same employer for 40 years anymore.
Yeah, that's true.
So you're going to have the opportunity. And when you're building up at $50 a paycheck, $200, $500 a paycheck, it's hard to buy individual stocks for that little amount because some of the stocks cost more than $500 a share.
So just listening to you here, the debate of the IRA versus the 401k, which may be better. Personal circumstances aside, I'm thinking maybe you like the 401k a little bit more in general.
I like the 401k. It's a lot easier for most people because you're signing up for something one way or the other. You're either opening an IRA account and doing the paperwork to sign that, or you're opening a 401k account to do that. But from that point forward, with the exception of the investment ability, the 401k just works easier.
Yeah.
The fact that you don't see it out of your checking account, you don't see it as part of your budget. It happens automatically. It's systematic. You have the ability to get those matching contributions.
Like you said.
Those are all wonderful ideas.
Well, they are.
And you can do more than $7,000 a year with it.
Well, that's what I was going to talk about here with the IRAs. You've got $7,000 if you're under the age of 50. If you're 50 or older, you have a catch-up contribution.
Whole 8,000 or not.
No, an extra 1,000. Where with the 401k in 2024, if this is when you're listening to it, it's what, 23,500.
23,500 plus a $7,500 or $7,000, whatever the number is. Catch up. I think 30,500 is the max. So it's probably 23,000 and
yes, it is. It is. You're right. Yes, 30,500 is the max
for 50 and older.
Yeah,
and that doesn't mean that you have to wait until the day you're 50 to start making the matching contribution.
Yeah.
I had this discussion with somebody the other day who was turning 50 this year in December, and they're like, "Well, how do I get I can't afford to put $7,500 of my final paycheck into the
in 1 month
in that last paycheck." So it's the year you turn 50. Yeah. So you can, if you wanted to, you could take 30,500, which is the max for that year that you turn 50 or older. Mm-hmm. How many times do you get paid? And is divide it and say, tell your HR company, you should have told your HR company or provider before the end of last year, starting in January, take out X amount of dollars.
Yeah, it's probably a good idea because then you'll be dollar cost averaging in throughout the entire year.
Now, I know some people that say, I can't afford it. So what, you get paid once a month, so that's a little over $2,500 a month. And they say, well, I can afford to do more than that because I have a spouse that's working too. So I want to get it all in right away. I know somebody who's putting in like $7,000 or $8,000 a month because they're living off their spouse's income, and they want to be done with it, or they're probably done with it by. Well, obviously they're done with it by now because this is later in the year.
Right.
But they did it. They fully funded it towards the beginning of the year. That may or may not make sense depending upon how your company goes about matching your contributions.
Yes.
Because
Now,
the matching contribution may be a specific amount of, they give you 50% up to 6%. But if you go over that, they only match when you actually contribute.
yes. So you lose that.
So you may not get the full match. I know that other companies say, well, we'll do that, but after the end of the year, we'll true it up so that you get the full. If you've put in your full 6% for the year, we'll put in the full 3% for the year, if that's the matching contribution. Some do and some don't. Just know what your matching
You don't want to miss out on. You don't want to miss out.
It's part of your pay package.
Yes.
Don't miss out on part of your pay.
Take advantage where you can. So now the 401k has higher limits. We kind of like that. Now, there are downsides to the 401k. What would be some of those, in your opinion?
I can't touch the money. I have a gatekeeper over the top of me.
That can be a very big one for some people.
Right. If they need access to it. I don't have the ability to do a 60-day, rollover while I'm still working for the company. Basically, if I needed a short-term, very short-term, the people have done this, infusion of cash, they can take money out of the IRA, and as long as they get it back within 60 days, it's not a taxable event. Now, they can only do this once in any 12-month rolling period of time. That's not available from a 401k. You can't take it.
If you want, now you can borrow from the 401k.
Right. Now, borrowing from the 401k, but sometimes there's a cost to that.
Yeah.
It's a pain sometimes. I know because I've done it, but in the past, I've actually taken loans back when the kids were in school. I needed some money for education. I didn't feel like going anywhere else to get it. But taking a loan against your 401k, you also give up the opportunity cost of what that money was in. So yes, loans are a potential advantage or disadvantage. People say, well, you're paying yourself back, instead of paying somebody else back. Yeah, but the money would have been invested in earning something anyway, hopefully earning. But then if it goes down, you could have said, well, I didn't lose it.
But is it a good thing that perhaps the money isn't easily gotten to out of a 401k?
Yeah, I think that, the more emotional or physical walls between you and the money. The reason a lot of people retire, the average person retires with more money in their IRA or tax deferred accounts than their personal account, is because they couldn't touch the tax deferred accounts without significant cost, significant hassle and penalty. And they say, oh, okay, it's just not that important for that brand new car or whatever the case may be.
Yeah.
But yeah, so IRAs are more flexible. The other thing, if I do want to take money out of my 401k and I'm not doing a rollover, I need 20 grand. Maybe it's my old 401k and I can access the money. They're going to automatically withhold 20%.
True.
And maybe I don't want them to withhold 20%. Maybe I've already done my withholding for everything. I'm just going to cut into my refund that I'm already going to get. I don't want them to withhold it. You don't have a choice. This has been around for a long time, where it's a mandatory 20% withholding from your 401k. That is not the same rule for an IRA. You don't have to do a mandatory 20% withholding from an IRA. You can tailor it. You can go more or less.
All right, so if somebody's trying to decide just strictly on the contribution side and they want to know about the pre-tax side, how would you sum up this? What would you tell them to say, well, 401k or an IRA? What would be the first thing you ask them?
My leaning would be the 401k, unless they just looked at the investment options and said, these options stink, and I do not want to be part of it. I know some people, especially the higher end workers, they don't want to necessarily put too much money in their 401k because they don't want their employer to know what they have saved.
Is that right?
I mean, I've heard it from more than one person. They don't want their employer to know that they've got a lot of money.
Why?
Because they think that it'll affect their future raises and
wow. So you've
already got a bunch of money. You don't need more.
The owner might look into their 401k balance and say, "I see what you have, and you don't need a raise."
You don't need a raise. Yeah, I'm not saying that's valid. I'm not even saying it's legal, but I've heard that concern from people that have a significant amount of money in different plans. They won't roll over their former 401ks or current IRAs into the 401k because they do not want their employer to know what they have for whatever reason.
I have, in all my years, I've never heard that situation.
I'm not saying it's prevalent. I'm just saying I've heard it
more
than
once. I get it. I think even if you've heard it once, this is the only time I've heard that. Interesting scenario. So these are the options for the pre-tax.
The 401ks do have one added layer. IRAs are fairly creditor exempt, but not 100%. And this is very state by state too. So different states have different creditor protection. 401ks are flat out protected from creditors.
You mean any creditor?
Yeah, they can't go after them.
Well, you have a judgment against you.
The Brentwood Offshore Trust is still alive and well. Yeah.
We can. It's been long enough where we can be a little light about that. Yeah, that's the.
Yeah, but IRAs, in most states, they're protected, and even rollovers from a 401k to an IRA are protected. But you may have to actually do something to protect it. So the attorneys may go after it, and you'd have to maybe file motions to say, no, this is rollover money.
Right.
So just if you're in a very litigious, highly expect to be sued area, maybe you like the 401k a little bit better. It makes life, like just a skosh easier.
So if you had $500,000, something like that, maybe more in your $1 million in your 401k, and you've got not much else, and somebody tries to collect from you, they can't touch that 401k.
It's harder for them to go after the 401k. They can try to go after the IRA, and then you'd have to fight it. You would probably win, but you fought it.
Okay. Well,
I'm not an attorney, but that's what I have heard.
Okay. All right. Friends have told you.
And again, it's state by state. Some states, IRAs are just sacrosanct too. You don't even bother.
All right. So these are the pre-tax options. 401ks, you've got more. You got a higher limit. You have a match, which I love.
Potential match. Not everybody has a match.
Okay, true.
But I hope you do.
If you do, you have a match. You have a match.
Lobby for it.
Possibility of a match on the 401k. Higher limits. You cannot.
Systematic, automatic. It happens before you see it in your checking account.
Another great.
Those are all nice things.
Those are all good things. All right, so that's from the pre-tax side. Now, some people have a Roth 401k.
One last thing is we know that the money that I put into my 401k is going to be tax deductible. Whether I put money into an IRA, I have to make sure whether or not it will be a deductible contribution or not. If I have a 401k and the company puts money into the 401k for me, profit sharing contribution, any kind of thing like that, I may or may not be able to deduct the contribution that I make to a traditional IRA. If I'm working, I can contribute to a traditional IRA. The question isn't can I contribute, it is can I deduct that contribution.
So anybody at any salary level can
if you make $1 million a year, you can contribute to a traditional IRA.
You just may not be able to deduct.
You may not be able to deduct it.
What's your opinion on a non-deductible traditional IRA strictly as a savings device?
Horrible.
Don't like it.
Unless I can convert it to a Roth IRA through a backdoor Roth, I would not do that particular after-tax traditional IRA non-deductible savings. That I just think you're just tying yourself to a form. Your heirs are probably going to pay tax on the money twice. You may end up paying tax on the money twice. It's a pain in the backside. It's not difficult. It's just annoying. You can't ever isolate the after-tax money and get it out by itself. So you're just creating an accounting nightmare for the rest of your life, unless you can convert it in an efficient manner through a backdoor Roth type of setup.
Yeah, and the reason is presumably if you have a non-deductible money in an IRA, if you have deductible money in an IRA and you're trying to take withdrawals from them at some point, you cannot just take it from the non-deductible side of the deductible.
The only way you can choose to take it from just the pre-tax money is to do a qualified charitable distribution. But there's no way to choose to take it just from the after-tax part.
No, and you don't even get the money for that QCD. That's not yours.
You got to be charitably inclined. But,
right.
So I don't like doing after-tax contributions to an IRA unless I can convert them in an efficient manner.
I got to tell you,
that's different than a 401k. If you make after-tax contributions, maybe you're in one of those mega plans where you can go over the $23,000 limit and do after-tax contributions to your 401k. That's different because they keep track of that. And when you ultimately leave that employment, you can separate the after-tax component of that 401k.
But again, that's a 401k.
The 401k has different rules. The IRA, you can never undo it.
I got to tell you, as I'm sitting here listening, I think the 401k has a lot more advantages here. I was already leaning toward the 401k.
For people building wealth, the 401ks are great.
Yeah. Now let's talk for a moment about the tax side of this. You said, of course, 401k tax deductible going in, but of course that means at some point when that money comes out, it's going to be taxed to somebody.
Same thing with an IRA.
Right.
So
Same
there's
thing with
no
an IRA.
advantage one way or the other between those two there.
But you may have a Roth 401k option.
More and more companies now offer the Roth 401k option, Roth 457, Roth 403b. Now we have Roth Simples.
Wow, really?
Yeah, starting this year.
Okay.
Haven't seen one yet.
Yeah. All right. Okay, so...
But having the ability... Now, so should I do a Roth IRA or a Roth 401k? Now, there are advantages similar to what we were talking about before, the ease, the simplicity, the higher limits. And now that we have the ability to take money out of a 401k without the pro rata rule later in life, and have to deal. There's not an RMD on them anymore for the Roth 401k.
Oh, that's right. Yeah.
So there's a lot of parity between them in that respect. But if you're going to do it, still start a Roth IRA, because you want that. If you're 55 or get closing towards 55, start a Roth IRA. Figure out a way to get a Roth IRA started so you can start that 5-year clock ticking.
Explain that 5-year clock for people who don't know.
We cannot take a distribution from a Roth IRA or a Roth 401k for that matter until we have had that particular type of an account for at least 5 years and 59 and a half.
You have so any Roth IRA needs to be 5 consecutive years. What?
Yes. Yep.
So you cannot have had a Roth 20 years ago.
I started a Roth when they first came out in 1998, and then I got rid of it for some reason, and I had in 2000 or 2010, and then I did not have a Roth at all in my name at any place. It doesn't have to be the same account; it just has to be continuously in a Roth in your name. And then I start one up now. I haven't met the 5-year rule again yet.
So to put it simply, you need to be a member in good standing of the Roth Club by having for at least 5 years.
And it doesn't require a lot of money; it just requires some. Because what happens if I ultimately retire and I have a Roth 401k, and I've had the Roth 401k for years, I've built up a lot of money in it, and I decide for whatever reason that I no longer want the 401k, I'm no longer employed there, I want to move it to an IRA, so I move it to a Roth IRA. And I want to start taking money out of that Roth IRA. I have not had the Roth IRA for 5 years.
Even though you've had a Roth 401k.
Different animal.
Right.
Is it going to be taxable? Probably not, because my contributions still come out tax-free. But I have to account for it on the dadgum tax return.
Which
I don't want to have to deal with that. I'm lazy. I don't want to have to tell the IRS, go away.
So as long as you're 59 and a half and you've had a Roth IRA, you've been in that club for at least 5 years.
It's a qualified distribution.
You don't have to.
Even if the money only showed up in the Roth IRA last week.
Now, what if you have a Roth 401k, but you've only had that for 3 or 4 years, and then you retire and you're not 59 and a half. No, you are 59 and a half, but you haven't had the Roth 401k. Is there a 5-year rule?
There's a 5-year rule on that as well.
So you need to
just
wait
another
6
more minutes, whatever it is. Yeah. But most people, have had the Roths a little bit longer. Hopefully we're going to live up to the rules, and we can use accounting to make it all tax deductible anyway, but still you have to do something.
Now you have to decide.
I like the Roth IRA because it gives us the ability to do things like I mentioned with the IRA. We could get the up to $10,000 for a first-time home purchase.
Mm-hmm.
That was penalty-free. With a Roth IRA, I have more flexibility. Let's say I've been contributing to a Roth IRA. I've been putting $5,000. I'll just make the easy math for the last 6 years. So I've put in $30,000 of my own money, and it has grown to $40,000. Purely making things up. I have no idea what rate of return that is, but It works for me. I can use that entire $40,000 for a first-time home purchase, or because I can use the $30,000 that I've contributed to it for any reason I want.
Mm-hmm.
And I can use $10,000 of the earnings penalty-free and tax-free for the first-time home purchase. So it's for younger people. It's great. The Roth IRA has some flexibility to help them build up some money for a first-time home purchase. That is not available from the 401k.
I'm surprised. We've had Roth IRAs for 25 years now, and I don't know why I'm surprised, but I'm surprised that many people still don't know the nature of the Roth, that you can take out your contributions at any time for any reason without penalty.
Right.
Even if you do it for 2 years or 1 year, 6 months.
There's 3 potential types of money in a Roth IRA. there are contributions. That's the money I'm taking out of my pocket, up to $7,000 this year, maybe $8,000 if I'm older, and putting it into brand new money that's never been in a retirement world before and going into a retirement plan. This one happens to be a Roth IRA. That's one type of money. Contributions. There's conversions. I can take existing tax-deferred money that's already in the retirement plan world, and convert the character of it from a tax-deferred retirement account to a tax-free Roth account. That is a taxable event when I do it, but now I have the ability to have converted principal in my Roth IRA. And the third type of money that could potentially be in a Roth IRA are the earnings. Hopefully you have earnings.
That'd be nice.
So you have different, and how you treat them, how the IRS, I should say, treats them is different. I can take my contributions out at any time for any reason. I just have to tell the IRS, yes, I'm taking my contributions out. It's an accounting issue, specific form, and it's not taxable and not penalized. It doesn't matter when the money went in. It could have gone in 1998, the first year they had it,
or it could have gone in last month.
January of this year. I can take it out for any reason whatsoever. Conversions have a potential 5-year clock on them. If you take conversions out, what they're going to look at, what converted principal amount are you taking out? You've already paid tax on it because you paid tax when you converted it.
That's how you got it into the Roth.
But there could be a potential penalty. First off, are you under 59 and a half? Yes, I am. Or maybe you can answer that correctly. Yeah. And if you are, they're going to say, okay, you've taken out all your contributions. You have no contributions left. So you're now taking out converted principal. When did that converted principal enter the Roth world? Was it, and they look at the oldest first. That's what comes out first. First converted principal in, first out. So if it was more than 5 years ago, it's already been paid tax and it'll be penalty free. If you're taking out money that you converted within the last 5 tax years, it's going to have a penalty with it if you're under 59 and a half.
What is that? It's a 10%?
10% penalty.
Yeah.
Some states have a minor penalty with it too.
So there is a potential, there is a 5-year rule.
There's a 5-year rule for the penalty on converted principals. When Roth IRAs first came out in 1998, they passed the law in 1997, and we're reading it all.
Yeah.
And we saw this, and we said, well, this is awesome because they didn't have this 10% rule or this 5-year rule on the converted principal.
Well, because it's impossible to have at that point.
Well, we could say, but we were looking at, as advisors, okay, they've given us a new set of rules. How can we use these rules to our client's advantage? And it was, we can now convert money from a traditional IRA to a Roth IRA and then get out of the Roth. Before the tax year even started in 1998, Congress got wind of it and said, whoa.
Wrong.
Okay, so we didn't quite think it all the way through. Surprise.
Yeah, right.
And they added the 10% 5-year penalty clock on the converted principal amounts.
Well, okay, fine.
Okay, so we have the penalty. There's a 5-year clock on the penalty for conversions. And then if we've withdrawn all of our principal or contributions, and we've withdrawn all of our converted principal, or we didn't have any in there.
Yeah.
Now the only thing left is in earnings. The earnings it can come out tax-free if I've had a Roth IRA for at least 5 years and I'm 59 and a half. But if I'm not 59 and a half,
doesn't matter,
or I haven't had it 5 years, it's going to be taxable. And it could be penalized if I'm taking it out before 59 and a half.
So taxable and potential penalties on anything before that.
So the penalties are always
rough.
Based on 59 and a half.
Taxable at your ordinary income tax rates too. So.
But most people don't have to worry. That's the nice thing. I don't want to say unfortunately. With inherited Roth IRAs, we do have a 10-year rule for most inherited Roth IRAs now.
In other words, it has to come out of the Roth.
Right. But we treat inherited Roth IRAs differently than we treat inherited traditional IRAs.
Yeah, that's good.
Where we don't necessarily want to leave the inherited traditional IRA alone for all 10 years and take out one big lump sum in the 10th year. We want to lessen the taxes on the inherited traditional IRA. With the inherited Roth IRA, if we can afford to do it, we're leaving that sucker alone for 10 years and letting it grow as much as possible so that we can get as big of a lump sum distribution tax-free as possible close to the end of December.
Well, see, there's some good in both. So if I'm going to summarize this, again, the pre-tax side, we really like the
I think the 401ks are easier.
Is a better deal.
I think they're easier with a higher contribution limit, potential matching contributions.
Right, all that stuff that we mentioned.
Easier.
All that stuff that we mentioned. On the post-tax side, on the Roth side, it sounds like you're leaning toward the Roth IRA.
Well, it depends. Have you already bought your first-time home? If you're not going to touch it, then I'm still going to go with the ease The higher limits, the happening before I see it, all of that still is true with the Roth 401k as well. But is there a reason why I should not use the Roth 401k and use the Roth IRA? I may want to do both.
Both, yeah.
And I may want to have that 5-year clock ticking. But the fact is 401ks are easy. And a lot of people retire with reasonable amounts of money in their 401ks because it's easy, because they don't look at it every month. They don't look at it every week. We tend to look at our IRAs more than we look at our 401ks. And we see the money leaving the checking account every month.
On an IRA.
We have to make, on an IRA or Roth IRA, we have to make sure the money's there, whereas it happens before we see the money in the checking account with a 401k.
Isn't that nice? I knew somebody who I was talking to her about her finances. I said something about a 401k. I said, well, how's that doing? She says, I forgot I even had that. Oh, yeah. Hadn't checked it in a year and a half.
Yeah, and it's probably a lot higher now than it was a year and a half ago.
Well, based on what's been going on in the markets, I would say so. All right, well, good. Hey, this is really important information. Once again, this has to do a lot of this has to do with where you are now and where you want to be from a tax standpoint. The Roth versus traditional is really a tax play, right? I mean,
in many cases, yes.
More
flexibility,
than any case.
Tax play.
Yeah, exactly. But if you're trying to make this decision, it doesn't always have to be one or the other. It can be both. But which one do you do first, perhaps? Yeah. Second, and all that. This is all part of the financial planning process.
Right. And it is nice to have somebody help you walk through what your options are and maybe guide you one way or the other or both ways.
It's not just nice, it's vital. Can I say that?
Okay.
Somebody like
nice
Professor...
to be nice to the nice?
It's just somebody like Professor Plum who got his MASH line in right before the end. Give him a call, 800-644-1150, the number at Lucia Capital Group, 800-644-1150. They do this stuff all the time. And I really mean all the time.
Oh, we do it all day.
It is. It's one of the things that you do all day. You can get in touch with them, as I said, through that phone number, 800-644-1150, or go online, luciacap.com, LUCIACAP.com. I'm going to mention again, don't forget, download your bucket strategy guide. You got a Social Security decision kit you can do there. We've got an estate planning guide. And there's other stuff. All you can find there just type in the search bar what you'd like to find, and you can download that stuff for free. Read it. Keep it handy. It's important to know this information, especially if you're going to go meet with an advisor. I think it's helpful to understand things like the bucket strategy and know what it is that they're talking about. It can help save time, right?
Oh, yes.
Yes. You don't have to know everything, but just kind of familiarize yourself with
if you know everything, come on down. We'll interview you for a job.
They'll be happy to do that. LuciaCap.com. Let's see, Spotify, that's right, and Apple Podcasts. Subscribe to this podcast. Do not miss a single episode. You get great information every single time, just like you got with today's episode at Apple Podcasts and Spotify. Professor, thank you as always.
You're welcome.
Wonderful show, and we've got more coming up. Next week, we may actually be talking a little bit more about this whole blending buckets topic that we discussed 3 or 4 months ago. We had some extra questions on that.
Creating efficient income from taxation.
That's it. More of this stuff coming up probably next week, but we'll let you know for sure. For Professor Rick Plum, CFP, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions in principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions in principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. 401k benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high yield, small cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a target date fund's mutual funds, exchange-traded funds, investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.